Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, November 2nd, 2023. It is 11:19 a.m. Eastern Time, so I'm starting the video and just want to do a quick update on primarily the markets. Well, and time permitting, I'll look at some of the other things that I highlighted recently, treasuries and a couple trades where you did the OJ futures trade. If you took that one's I think probably has more potential than about any one that I have out right now. But let me start out here with the equity markets. So to kind of recap what's gone on last few weeks. Oh, here, let me do this. I just pulled a couple charts. Okay, so going back here, look down the bottom. This was September 28th. We had a similar setup to what we just had now. We had my beloved positive divergence there on the 60-minute time frame, which is my go-to swing trading time frame, and laid out called for in position for a bounce, heading up to the maximum target, the downtrend line, or there's the primary downtrend line, or the 372 level, and they came in roughly together. That's why that was the max target. So that was then we went on to hit that to the button right there, and had you got it, my beloved negative divergence. Love them all. Positive divergences are bullish. Time to go long. Negative divergences are bearish. Time to go short. It was highlighted too right when we hit it. That was a very objective, and still will be if we hit it again. That's why I'm doing this video. Try to get these levels out in advance. So when they're hit, because I'm not always in front of my desk or have the time to fire off a bunch of charts, but that was, again, this was October 13th now at that point, and then had us turn around, get back short again, go down, make a marginal new low, and that's what we did. So that was then. This is now, takes us full circle, 60-minute chart, this board here. And then mentioned, again, we had divergent low here, but more so this time around. See, those are the last two swings here, up there. Let me use a blue arrow, swung that divergent low and then got short, swung that down. And right here, last week is where, again, more so, we did have divergence here on the RSI. That's positive divergence there. Slightly lower low on the PPO, but the more significant daily charts came into play. So again, this is just kind of recap, but it's also, hey, where are we going from here? So a few, last week, stated going long here, and a couple things. I said, most people, that's when everyone wanted to short. We just started moving. The selling had accelerated. You can see the two red candles at that point. It's where, again, the folks that didn't want to short when we were in rally mode at the highs, that's when they wanted to short. And that's when you got to get out of that mindset of, again, I always say this, you don't want to be contrarian just for the sake of simply being contrarian, because there's nothing to say that, the bottom couldn't have fallen out. And I warned of it, if we went much lower. However, that's not what happened. And because this was more significant what happened on the daily time frame, and that is the not just QQQ fall into the 200-day exponential moving average, but is, again, there's a lot of this is repetitive. The majority of the market leading Magnificent 7 stocks falling to comparable key moving averages and or price support levels, or those purple levels that I had, which were key support, like Apple 166.61, Microsoft yet to break it and actually had just broken out. Alphabet, key support resistance zone right there. I mentioned going long on that one just last week with the 200-day moving average and a really nice support zone. It's resistance once you're below it. It was resistance back here. That's why I called it support resistance zone. And when we take it out, which I believe we will, then it'll become resistance again. Amazon, beautiful rally off I believe in the after hour session, it hit that. There's the 200 simple moving average and the primary bull market uptrend line, or at least the counter bull market rally uptrend line, if I'll refer to it as, right there. And again, so the rest is history. That's what's happened. Now let's talk about where we're going from here. There's NVIDIA. Again, so the bottom line, the takeaway is we still haven't taken out those key purple support levels, which, as I've been saying for literally months now, unless we do. And when we do, that'll open up, I believe, the next major leg down. If we take out the 200 days, they're all right around there on most of them, the 200 simple and exponential. So I am still expecting that. But like I said, nothing goes down forever. A lot of these key stocks, including NVIDIA here, hit support. And they didn't just hit support. They had positive divergence on the shorter term, if not the daily. A lot of them had it on the daily, including Apple. But so that's it. All right, so that's what's happened. Now, a couple things. I just want to recap things I've said over the last week. Going back to QQQ, one of the things is, other than, everyone wants, you want to kind of not short and or go long when everyone else wants to short, but not solely for that reason. You have to obviously make a case technically. Are you at support? Are you oversold at support? Are the majority of market leading stocks also at support? Because sometimes QQQ could fall to support, but if I've seen Apple, Amazon, Microsoft all breaking support, then guess what? That's a drop to support on QQQ. I'm not going to buy, because that means that's probably going to give way when the rest of the stocks in the Nasdaq 100 do. So this is still, and has been, still potential bounce target. But I'm going to give you my thoughts here right now, real quick. Okay, one of the things that I had said in recent videos is I expected an upward bias, upward move in the market into and after the FOMC meeting. Yeah, I took a shot at a downtrend line yesterday on a short trade. It didn't pay, and we just went right through there. There wasn't even any reaction. And I'm actually taking another shot here today. I'm going to get to the VIX for you in a second. That was also a trend line support, but now it's at even better horizontal support. Again, 1 minute, I'll get there. So what I had said is I expected the market to rally into and beyond the FOMC meeting into some point Thursday, and then at that point, and I highly expect this, I'm heavy short right now, and if we continue up higher, I'll be heavier short. I think we'll fade this rally pretty good before the close. There'll be some nervousness about Apple. Yes, I did say Apple has probably the best looking chart out of all the market leading FANGs recently. I said that multiple times in these videos. We held price support, which was my key, bottom lower purple line at 166.61. We also had the positive divergences on both the RSI and PPO here on the more significant daily chart, as well as the 60-minute chart. That's just a great looking setup. How can you not like that? And again, reason I've been, reverse long last week. And then now, however, a couple things. You are now at the downtrend line. Remember, that was a potential bounce target for Apple. This does form a big bullish falling wedge. So here's in a nutshell what I see. And I said this before. You'd kind of want to, I said, I think this rally will get right as it just starts to look really enticing for the bulls. Right when everyone feels it's, those that didn't want to buy last week or earlier this week or pre-Fed, they're buying today. And again, the Fed announcement was an 110% non-event. It was what we expected. I don't think I can recall the Fed fund futures being the probability is so high. It was almost a near certainty that they wouldn't hike. And so you could see that at 2 p.m., there was no movement in the futures. Usually you see the futures kind of all over the place. Even after Powell's press conference, we drifted higher, but again, the Fed meeting was a non-event. So here's where I'm going. Apple is everything. Right now, and if you recall, was what I said, right when this thing starts to look enticing is when we could see it fail. And so, okay, let me say that. I'm going to try to bring this home and summarize my thoughts. This is, as I've been saying for the last week, the most bullish technical setup I've seen in a long time, since all the way back to January lows. Remember back then, I was out and out bullish and long, naming two stocks of my top picks, Amazon and Apple, my favorite picks, and also predicting the FANGs. I'm coming into the year, January 4th, 5th, whatever that was, and saying that the market-leading FANGs and the Nasdaq 100 would outperform because we had just beautiful, same thing, positive divergences, key support levels on all the big FANGs. Remember, the market itself bottomed in it was actually in October of 2022, but not the FANGs. They all bottom, most of them here, and that's where the rip started. And so, again, let me reiterate, this is by far the most bullish setup I've seen since back here. And yes, I was recently long. Why am I not longer term bullish? I'm very much open to it, but I kind of have a script in my head based on everything that's going on. You can call it bias if you want, I'll recognize it, but you have to have some kind, this is my trading style, you have to have a map. Kind of like a football coach going into a game. He's going to have a, he's playing the Bucks or whoever they're playing that weekend, and they're going to have a kind of a map in their head how that game might go. Hey, they have a strong defense, weak offense. This great. This can't let this. You got to shut down the running game on this running back. But then when you get into the game, sometimes things happen, and there's an injury. You have a key player injured, they do, or the plan that you had isn't working, so you have to adjust it. But the key is you have to go in with a plan, and so I'm going off the primary view, which I've been going off of, and it's been working well so far, that this has just been a bear market rally off the lows here, and that this was most likely the top. I have not yet ruled out my marginal new high scenario, which is still a near-term bullish but longer-term bearish scenario. However, it's still not my primary scenario. So what I believe, when I know I said in one of the videos last week, on the last week or so, is just as this thing starts to look to be getting good and starting to suck a lot of bulls and longs back into the game, blowing out a lot of shorts, is where it could end. Now that is a highly contrarian call, and it's a kind of a gut feel, instinctual call. The technicals, by all means, tell me to be long and stay long now, at least, at minimum, to move up to this downtrend line in QQQ, based on the fact that 200 days were not only successfully defended, as I mentioned before, it's even more bullish when you slightly undercut a key support level and then recover it, because then you have a little false breakdown, i.e. bear trap. That means short sellers, the 200's taken out, and they jump the gun, they short. They're all getting squeezed right now. And so that's what you get here on this kind of move. So by just about every technical measure, if I discard what I think is the bigger picture, yeah, you need to be long right now, or that's what the charts would say, because we're not yet based on everything. I mean, we have the bullish falling wedge I pointed out here. We just broke out of it. The measured target's the widest part of the wedge, which would be all the way here. So that would take us up to there or beyond. So there's a lot of technicals pointing to this. And so let me just say it this way. Here's how my brain analyzes this, I process this. The probability for this is higher, that we continue on up, and maybe even based on the fact that 200s were just tested and successfully held. Long-term trend indicators, even my monthly trend indicators, are bullish at the moment. So that would indicate that we run up there, maybe get a reaction, then break out. However, mapping off where we are now, factoring in fundamentals, which I very, very much do. You can't trade them day to day, but they do factor into that longer term map of mine, that bigger picture. No better time to just catch the market off guard. I can think of no better time than tonight. And again, because Apple has one of the most bullish looking chart setups here. Again, I'll draw it out for you, take off all the lines, and let's just draw it simple. And this is what I've been highlighting here. There's your clean, very clean, well-defined downtrend line off the highs. I might have missed the point right there. Positive divergence here on this more significant daily, and very much on the 60, as I just showed you earlier. And so, the odds, just looking at this in a vacuum, Barna, that favors a breakout, even if we have a pullback first. Now, as I like to say, resistance is resistance until it's broken out. I also say this. The initial reaction after earnings isn't always the last reaction. If I had to just venture a guess, maybe a pop, big after hours pop on earnings. Rosie, Apple never misses. They always have phenomenal earnings. They almost always beat. And then again, it's not what they do, it's what how the market reacts. So it's certainly not an all-in long or short moment. It will not be an all-in short moment. When I say all-in, I mean super aggressively. And I'm talking swing and trend accounts too, guys. By the way, I need to compartmentalize that, or differentiate it between my active trading account, how I trade, and then long-term stuff, 401ks and all that. That's a whole different thing. So that's it. So we're right now coming up at resistance, and especially Apple bulls, I would be surprised, or Apple longs, if you didn't see some profit taking here coming up to this trend line before the close today. And then again, based on these breakouts, these downtrend line breakouts, there's Apple. Let me go over everything here real quick. Apple daily chart held the 200s on the 60-minute chart. Just keeps breaking out of one level after another. There's the downtrend line right there. Oh, no, I'm sorry, that's QQQ. That's not Apple. There's Apple. There's your downtrend line coming up to it right now. Again, resistance, but based on this big positive divergence, which would indicate a much higher move up. Daily chart, same thing there. That's what I tried to cover. Microsoft, remember, Microsoft already broke out of a comparable bear market downtrend line, or not bear market, near term or intermediate term downtrend, but also put in some divergence there before it broke out. It's been moving higher, so there's nothing bearish in this chart right now. In fact, it just went down and ran at its 200 days, 200 simple. Alphabet, I already covered that one. That was one that I took long the other day, and that was in even swing accounts as well. But look at where we're at now. So here's the thing: this is time to, if you haven't yet taken a quick profit, you have a big resistance right here. My purple line was right there, 127.15, but there's the gap right there, and we're right now. I mean, you zoom in, see the top of the gap. That's where we're at right now. So a lot of resistance levels. If they want to backfill the gap, it's all the way up there as the top, but there's just a mountain of supply, meaning overhead resistance, before it does it. Amazon, again, Amazon, boom, beautiful reversal and bounce off the trend line, didn't look back. Again, also had, as I mentioned, bullish looking chart. Remember, we play the game of which stocks are going to do well before or after, do well or not do well going into earnings, and typically the ones with the most bullish charts do well, the ones with the most bearish charts don't. So yeah, it is kind of conflicting right now, because Apple has a bullish chart, no doubt. And if we take out those near-term downtrend lines off the highs on QQQ and Apple and a lot of other things, one of two things: it's either going to be the real deal, and we'll go back to that, and it sticks, meaning that will increase the odds for that marginal new and divergent high scenario, which is still a near-term bullish but longer-term bearish scenario if it plays out. If it would go up anything more and we burn through the divergences, then it's just, like I said, I'm just dead wrong. There's something else going on here. But that is still my most optimistic yet longer-term bearish scenario, near-term bullish, long-term bearish. But I don't favor it. I've seen a lot of red flags. I've seen abatement. What I'm looking at today, I look at my things to watch list, all the stuff that's been pounded down. A lot of it hits support. But it's a lot of short covering. I'm looking at KRE, the regional banks. I'm looking at the crap, guys, the crap that's just been beat down, and a lot of those red flag things rallying in sympathy with the fact, and I don't get why they waited till the Powell made it official. I guess most people don't have the insight or know how to look at the Fed funds futures, which I told you, go to CME Tool Watch. It was like a 99% probability they wouldn't make any move, especially a hike, and but yet, I guess they wanted to make it official. So that's my thoughts, guys. This is the relief rally that the hikes are over. And even though Powell, like I said he would, he still talked the hawkish talk. Oh yeah, we're going to leave another cut on the table if things get heated up. Of course, he's going to say that. That's rhetoric. And again, the thing is, the Fed, this FOMC meeting's out of the way, so we don't have, the market's got plenty of time to worry about what Powell's going to do until the next one. So now I think we turn ourselves back to the macro. The macro meaning, the fundamentals, and that's not just the big FANG earnings. Apple's going to be a big one. And so here, let me try to bring home my thoughts on that again one more time. So again, the probability, because this is a beautiful looking charts, the 200 days have just been, for the first time in a long time, we got really far away from them up here. These are the 200-day moving averages down here. First back test in a while, at least on Apple, it tested here and then just undercut. But again, QQQ and some other things for the first time in a while. And so that's where, like I said, I would be surprised, not shocked, but surprised if the buyers didn't step in and buy that first test of the 200. And they did. And all I was looking for, and still am, is a reflexive bounce. And so here's where I'm going with this. This is, again, technically speaking, not just the markets, but all the market leading stocks that matter and move the markets. The best looking, the most bullish technical setup in case I can make to be long since back here. However, it's very contrarian, but I'm suspecting that something is going to go wrong, whether it's what Apple says and how they report or just how the market treats the stock, whether they break out above that downtrend line or not. And then if that happens, it's what helps me fit my narrative, because I told you I have this map. And the market, to call big drops in the stock market, it's very, very difficult. Your timing has to be precise, and the odds are extremely against you. November is historically one of the best months in the stock market, blah, blah, blah. And so for this to happen, what has to happen is the masses must not think it's going to happen. They must not be positioned for it to happen. I think you know what I'm talking about there. In other words, short interest, when short interest is very high, that puts a floor in a stock or the market, anything that's highly shorted, because those shorts are, I've always said, are the only guaranteed buyers in the stock market. Let me repeat that. Short sellers are the only guaranteed buyers. You can have a long-only mutual fund or hedge fund that only goes long, and they might have $1 billion in cash, whatever amount, you pick your number. And they may be foaming at the mouth bullish and wanting to buy, but they don't have to buy. They can see a reason that causes them to pull back and wait and hold off. Short sellers have to buy whatever they're short, because that's how it works. You sell a stock first, and then you buy it back at hopefully a lower price to make a profit, or you buy to cover at a higher price if you're wrong. So those short sellers must close out their positions. That's why I call them the only guaranteed buyers in the market. And so when you have a lot of shorts in, what happens is every time you get a little dip, along the way, it's incremental, not all, none, you get the short sellers that are covering, taking profits. Likewise, when everybody's all bearish, put to call ratios soar, you got a lot of put buying. Those puts, the market can't make, the majority of options buyers lose money. That's why the smart money, the institutions sell options generally, and the dumb money buy options. That's, retail investors. I'm not trying to insult anyone. That's just how it's known on Wall Street and how it's said, just like that. So this little punch up here, when everybody was getting bearish, is clearing out what I call those JCL shorts. And I have a little doubt that a lot of what we're seeing in the last few days is short covered. Now the $1 million question is are these technicals going to play out? So it is an against the odds bet, less favorable. But if Apple, to go home short, and I will, against strong technicals, I even will ride out, expect we might see Apple pop initially after earnings, but I think ultimately by next week, any breakout in Apple, unless it just craps out right away, which would be even more bearish. More bearish for the market. If Apple just craps out, and then what I'll be looking for, what will I look for if they can't pop this trend line? Number one, which I've been saying for months, we can get rid of that 170, right? Because that was my upper purple line. It's still support. I'm going to leave it there, but basically the recent lows around 166, because to do that would mean that we already tested, undercut, and recovered the 200s. Another move back down will take out the 200s, and once you've already tested them, especially an undercut and a recovery, that shouldn't happen. Okay, that just shouldn't happen, and if it does, it's bearish. More so if we can take out the purple level, just because it's a key support level I identified months ago. That in itself would be a check mark for the bearish case. And then also these divergences have the potential to get taken out. And then if you no longer have divergences here on the daily and or that 60-minute chart, you've just now taken one of the most bullish setups or the most bullish setup in Apple in almost a year, again going back to January, the beginning of the year, and you foiled it. And what I've said repeatedly over the years has been my experience is fewer things, if any, are more bearish in the markets and trading and technical analysis than a failed bullish setup or bullish breakout, bullish chart pattern. Because, and this is just my logic, again, it's been my observation that's the case, that when you fail to either a false breakout followed by a failure of the whole thing, or it just never materializes, this beautiful bullish falling wedge just doesn't play out, and then the divergences get taken out. One of the reasons I think that's so bearish is for the same reason I said a minute ago. It's the positioning. I have to imagine I'm not the only one seeing Apple coming down to and successfully recovering the 200s, both the 200 simple and exponential. So that in itself was a bullish technical event. The positive divergences, everything I've cited, the fact Apple, the most beloved stock in probably in the world, was down 16%. So all those folks that didn't want to buy it here when, because it was at multi-year lows, they didn't want to buy it here, but guess what? I promise you they wanted to buy it here, or here, or here, or here, but it just didn't let them in. They wanted to wait for a more reasonable price. They didn't want to chase a 30, 40, 50% rally. And so, like I said, they got their opportunity here. So there's 101 reasons to be long and bullish Apple right now, and a lot fewer to be short and bearish. And because of that, it would just catch the market and market participants off guard. So, all right, that's it. I think I drove home the point. I know I was kind of rambling all over the place, but that's the odds are not favorable to see the market tank after Apple reports tonight or into next week. Again, whether or not we are up tomorrow, it's next week. It takes a few days after earnings, a couple days at least, for the market to really decide which way it wants to go for a key stock like this. So again, a very contrarian call, but then everything I frame all my trades and I look at RR, risk reward, and it works out this way almost always. The trades that have a higher probability of success, the ones that are clean, no-brainer trades, let's say it's a stock that's pulling back to a support level that is super solid support, positive divergences, every indicator lines up. It's a 10 on a 1 out of 10 bullish trade. So that would be a high probability trade, I call it, meaning it has a high probability of success. But typically on those trades, I find that I have a lower RR. When I look at my price target relative to where my stop is going to be, the RR is 2 to 1, 3 to 1, maybe 4 to 1. It's the trades that have a much lower chance of playing out, because like this, expecting Apple to go this way, those have a higher probability of success, but a much, much larger RR. Because if this happens, if Apple craps out, it's going to take the market down with it. It's going to take the breakouts and Alphabet and Amazon and everything else. It's going to take those stocks down with it, kicking and screaming, and there's going to be huge position shifting in the markets. A lot of longs, all those longs that they didn't want to buy Amazon here, but they wanted to buy here, 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 here. And there's a lot of those folks. How do I know that? Well, let's just do it this way. Let's look what happened going down into earnings right here. You can see this is I just went to a 5-minute chart here. Let me just tweak this line because that's bothering me. These volume at price histogram bars right here, they show you at what price level the majority of trades. So this was heading into earnings, some selling there, but you can see huge. These are where the big purchases went. So everybody in the last couple of weeks that bought Amazon bought here. These people, again, if that happens and we move down, there's a ton of trapped in unprofitable longs that jumped in late. Obviously, I'm sure some of that was short covering as well, but you get the point. And, this is just a 5-minute chart, but I'm looking and I'm starting to see some nice divergences form here. That's a 60-minute chart. No real reason to sell Amazon. But again, if Apple takes the market down with it, or takes the market down, ultimately it's going to pull Amazon and everything else down with it. So again, highly contrarian trade. Do what you want. Certainly not a time to be all in aggressively short. But based on what I got out to you this morning, let me give you an update there. This is the chart. We haven't moved. We're still there. I said 14,955, an objective short level. This is the fade I see coming today before the close, most likely. I will have to suspect there'll be some profit taking. I know right now people are tripping over themselves to get anything long tech related. They think, because I don't know why. I guess because Powell said it, that the rate hikes are over, at least for the time being. There's an uptrend line off the lows. These are all support levels, which are potential targets as well, guys. If we move back down, how far we go will depend on probably carry over after hours today. I don't think we'll see a drop this big before the close today. I would welcome it, but either way, I can tell you we're at a pretty good resistance level right here. And that's the one I pointed out this morning. And the market's gone nowhere. It's stopped cold there. There's the primary downtrend line. It goes to the left of the chart. Let me show you one more thing here. And this, of course, was a divergent low. Another reason to be long recently on the Nasdaq 100 futures, positive, aka bullish divergence. But when I toggle that over to a 6-month chart, I have some fibs I put up for you. Fibs are Fibonacci retracement levels. The way that works is you have a starting point here, and there's our correction. So that was the mid-July highs right there. And this is the recent lows right there. Forget about the DLs. That just carries over these commentaries. These annotations carry over from that other 60-minute chart. And what this is, these are your key Fibonacci levels. If you're not familiar with them, read up. I don't have time to do a full-blown, how fibs work. But these are the key levels. And what these are, I look at typically, from my experience, again, a counter trend move. And remember, in a downtrend, a counter trend move is a rally. So this is, you cannot argue, no matter who you are, it's not up for debate that this is a near-term downtrend, at least since that high, because a downtrend is defined as any security making lower lows, which it has, 1, 2, 3, or 4, whatever, however you want to call it, and lower highs. These are all the lower highs, right? It is a undisputable, unmistakable downtrend. Now, the million-dollar question, is the downtrend over or not? Has it run its course? I can make pretty decent cases. I have for the last week now, and for the same reasons, being long at that low. However, I don't think it's over. And one of these things fibs do is they help you identify both objective levels to trade off of. What that means, okay, in a downtrend, which let's just assume for a minute this still is, with more to come, then you want to short, because the typical counter trend rallies will end anywhere in that range normally. Sometimes it can go up to the 71.6. And you'd be amazed, and I've said this many times over the years, just how often these levels work. And more so, it never ever fails to amaze me. I always mark up my price levels first, like I just showed you a minute ago. I did not put these fibs up to today. In fact, I didn't put these fibs up till after I got that chart out to you, the 60-minute chart I got out to you this morning, the one I just covered. And on top of that, I haven't touched that line. That line was created way back, I can't remember when, but a while ago. And so here we are. I toggle back over to the, remember, we're at that resistance level, price resistance, and it's also fib resistance. So what I'm trying to say is it never fails to amaze me after I've done my price resistance levels, and then I throw up the fibs, and the fibs are, there it is. You just take a key reaction high and a major reaction low, put them up. You can use fib clusters by going, like, for example, fib cluster, you'd put up another set of fibs coming down from this reaction high to the bottom here. Here, we'll do it. Let's just see. I haven't done it yet. Let's see where they line up. But those you call fib clusters, and what you look for is you look to see if you get, and there it is. It overlaps. It's a little messy. and that's a fib cluster. What I just did there, you can't see it now because the lines overlap. So that's a 61.8 fib. So in other words, I put up fibs from that move down to here, and it lines up. It just populated a 61.8 fib. That means a 61.8% retracement from that recent high there. Let me delete this one, remove all fib lines. Oops, no, I didn't mean to do that. I just took away all of them. Okay, one more time. I'll just put the main ones back on because that's what I wanted to start with. That's the primary move. And again, point being, we're at the 38 fib, and that is atypical. So this whole range here is a typical counter trend bounce if I'm right, and if we're going a lot lower, if this downtrend is going to resume or continue, if we're still in a downtrend. And look at this. If we want to, let's say we jog down here and then we come up, there's the 50% fib should come in with the primary downtrend line as well. So takeaway, guys, there's a confluence of resistance. There's no technical evidence until we punch through the downtrend line. That would be a big one, a solid move, a solid close, and then that 61.8. You can argue what and say what you want to say, but you cannot yet say with any degree of confidence or technical evidence that this is anything more than a counter trend bounce, because we're still, well, we're at the bottom level, bottom range of what a typical counter trend rally will usually go to. All right, guys, enough on that. I'll go back to the VIX. I just wanted to jump, for those of you who took, I threw out this, and I buried this. I didn't bury it, but I put this trade under update for the gold and silver trades recently, just 2 days ago. But I think it has, like I said earlier in the video, probably more profit potential than just about any other trade out there right now. These are, I had the line there before. These are orange juice futures, and I'm using this chart because my other chart platforms don't let me draw these parabolic lines. I don't use them often. That's why a lot of chart platforms don't even have them, but some of them do. And this is just a beautiful trade. So I am going against Randolph and Mortimer Duke. For those of you old enough to remember the movie Trading Places, those guys, those two old farts tried to corner the orange juice market, and orange juice, what we're looking at are frozen OJ futures. And we're going back years. This is 2012. They've never seen anything close to this level. And I gave you a link to the article. It's decimation of crops here in Florida from the hurricanes. There's a blight going on with some kind of insect, beetle or something, and all kinds of things, blah, blah, blah. Okay, but nothing. All I can tell you, yeah, there was a fundamental reason for that. And as I said the other day, about a month ago, a subscriber brought it up to me saying, hey, look, time to, short or look at orange juice futures. And I said, no, not yet. I've from doing this long enough, I've learned don't fight a parabolic trend until you see it break. Although I did actually, and as I posted that day, I shorted it before the trend line broke because I was waiting for evidence. Bottom line is, the evidence came in the form of a big reversal intraday and that buying climax. Again, it's all in the post I gave you. Negative divergence, but look, the parabolic trend line has clearly broken. We're already up double digits, I think 12+%. If you shorted it, that was the day of the high right there. And on that setup I gave you, I had a sold target. It's going to be close to a 50% profit, or really a double on your money if you look at it that way. I call it a 50%. Because it drops 50. The way it works is, if you sold it, it's a 45% drop. And, short selling is buying and selling in reverse. You sold shares here or contracts you didn't own, and you're going to buy them back here. So you're going to buy it at this price, technically. So, 50% drop in reverse is a 100% gain. So, but I do want to, the reason I'm doing this, I did have some other targets. So I use, going down to this chart here, I do have, this was a near-term trend line, which is clearly broken. And like I mentioned, bearish engulfing candle. So after, the day of the trade I gave you, we put in, and then that bearish engulfing was finalized. And these things have been hitting lock limit down. And I love this kind of trade because they don't let the longs out. You get these lock limit things. And what happens if the futures drop enough in a day, they limit it, they lock it down. And anyways, so bottom line is, I said in the first post that parabolic trends typically, I've never seen them end well. They just don't. You usually come down just as hard as you went up out of the last parabolic run. And anyways, I wanted to give you, you can replicate this as a daily chart. Here's an uptrend line. That's first potential target and a second target here if you don't want to go for that aggressive 45%, almost 50% drop. About 300, and then there's that target I gave you on that other chart. It was about 235 ultimately. I think we'll probably get down there. I just wanted to update that. And before I wrap it up, my apologies. I should have done this with the equity markets. Is that VIX trade I pointed out, always say you miss 100% of the shots never taken. So I pointed out, and there was a trade, at least a reflexive bounce, a trade to be made when we hit that trend line yesterday. That's where I got it out to you, and we bounced. It was a good 2-3%. Is that what it was? Let's see here. We bounced from right here. Yeah, there was about a 2.5% bounce off there. So there was definitely a reaction, helped to validate that trend line. But look where we're at now. We're back to, remember where we first entered this, and there's been multiple reasons coinciding with both this chart and the stock market. T1, this is T1 right here. When I move, these things move. T2, so you're able to sell at T1, as I mentioned at the time. Nope, I take that back. Right here, we bought it here. This was the original long entry right here above this support buy zone. We rallied up and then hit T1. At that point, there was a good chance for a bounce in the market. So you were able to, book the quick profit on this trade of about 18%, turn around and either sidestep that 12, 13% give back or turn around and short it. Because again, there was a case to be made for the market to bounce. And plus, I point out T1 was hit, and that was T1 right here. Then we went on, as often, you make pull back and you go power hit T2. So what happened? There we go. T2 was hit. You had not one, but two opportunities to exit T2. And again, as I said the other day in updating this, to be bullish and long the equity markets is to be bearish and short the VIX. There's no two ways about that. So you had an opportunity, two opportunities to close along at T2. Again, the reason multiple targets are listed because upon the initial tag, I'm sorry, this was our first entry. Upon the initial tag of each target, you're likely to get a reaction. And so then we came down here. We did have a bounce yesterday. We went through there. But look, we're right back to that. If this was a support zone before, where we first bought, and we had a reaction off it, right dead in the center. Remember, support zone is when I have two support levels in close proximity. So I don't know which ones, they're both just as valid or anywhere in there. So if it was valid back then, before we even got there, we were falling down to it. The fact we reversed and had a huge rally off it more than helps to validate it. So here we are again. I just wanted to point that out. So along with that objective short level I gave you today and just now in the video, as well as that post earlier today, here we are again. And so the same thing holds true. If you want to recycle in, if you took profits at T2, T1, if you missed the whole thing altogether, this is an objective long entry all the way down to just as before, down to but not below. I would not add below the bottom of the support zone. That's about 21.24, and your stop should be somewhat below it. Now, again, the probability of success is going to, just like the stock market, might be low, especially after such a hard fade of the VIX here. However, it's all about RR. So let's say you take a shot here, and let's say, I can tell you, if we're going to go up, if the only way it's going to run up even to T2 again is if Apple craps out after earnings. And the fact that we've already checked T2 not once but twice, to me, strongly increases the odds. If we run up again, we're going to go right on through there. And probably a good chance we could power right through T3. So again, I'm trying to frame this in RR probability of success and everything else. The RR, if my fifth, let's just say T5 is hit, that's a 55% return. Your stop loss is down there is about 5%. You're talking a 10-to-1, 11-to-1 RR. That's phenomenal. To me, it's worth a shot. Wouldn't put your 401k money into that. Obviously not, but it's worth a shot at a small position, Vegas money. And look, Apple's reporting tonight, so still not an all-in on the VIX. You got to be careful, but you could always add if tomorrow and then into next week the market starts moving down, the VIX starts moving up. At least you got a starter position there. So. All right, with that being said, I'm going to wrap it up here. My thoughts. I know it was a long video. I know I kind of threw a lot out at you, but that's it. So like I said, very constructive price action and bullish charts lately, especially in light of the recent bearish sentiment. Everybody got so bearish heading into the lows last Friday. That's why this happened. That's why hopefully, if nothing else, your takeaways from the site is, don't don't follow the herd. The herd right now is buying. Maybe the herd's right. There's a lot more to come. Again, this rally was anticipated, but I think there's a good chance it's going to be over, and I'm pretty sure we're going to know a lot better by tomorrow once we see Apple out of the way, and certainly into next week. All right, I will wrap it up here, get the video out to you guys, and then I don't know if I'll post after, because really Apple can be noise up until after the initial report. Don't go off what the stock does in the after-hour session. Wait until the call's over, and if you want to be safe, wait until tomorrow. But I like scaling in. It's time to me scaling back into shorts, scaling out of longs, and then I'll maybe singing a different tune next week if everything goes Apple's way and the market's way, and we start seeing another objective level to get back in. Maybe I'll start posting some more long trade ideas again next week. But as of now, focusing on getting back into those shorts. This has been Randy Finney with Right Side of the Chart. Have a great day.